You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The thesis for precious metals, in particular gold, just has never been better. And with some of the new companies that are coming out, and they're very good teams in my view, there could be a lot of value created and profits for investors. And so I think this is, out of all the sectors to be in right now, I think the gold sector is where you want to be.
This is Mining Stock Education, and I am your host, Bill Powers. Thank you for tuning in. Well, we're touching base with Brian Leni. He's the founder and editor of Junior Stock Review. Find more about Brian's subscription service at juniorstockreview.com. Brian also has a free email list that I'd encourage you to sign up on, and that again is at juniorstockreview.com. Brian, thanks for coming on Mining Stock Education. Again, I appreciate your time and joining me today. Let's start talking about M&A, mergers and acquisitions. Do you still feel like, with where we're at in the gold cycle, that it's good to look as possible investments, possible takeover targets?
Absolutely. Actually, I think it's going to be quite a hot portion of the market in the near future. I think the only reason why we may not have seen it on a grand scale right now is considering all the uncertainty that's in the market. And, the next, even leading up to the end of the year, I think companies are still kind of wondering what's going to happen, maybe with this second wave of COVID and, the other stuff that's going on in the Western world with the protests and such. So, M&A has been on my mind for the last month or so. And I've been trying to identify what I think are the top candidates for this next M&A cycle.
And what would be some of the, let's say, the top three qualities that you would look for in a takeover target?
The first thing that comes to mind is probably jurisdiction. I think that at least in the immediate term, tier one jurisdictions are going to stand out. And, those being, Canada, the US, Australia, parts of Europe too, depending on where it is, will be at the forefront of the M&A activity. And just because, when you're dealing with an uncertain world, I think you can depend more on those tier one jurisdictions to be somewhat stable. And so I think that'll be the focus, at least in the immediate term. Next to that, I think there's kind of going to be a focus on quality over quantity. In the last cycle, we saw, more companies playing to the quantity, meaning they were trying to add as many resources or many ounces of gold to their bottom line. I guess that's kind of what the market was asking for. But this time, I think it might be a little bit different. I think they're going to go for quality first. And so they're probably going to look for stuff in, first quartile economics, and that's got size. And by first quartile economics, I mean, all-in sustaining cash cost. In terms of gold, let's say it's the AISC for their operation. And then next to that, it's tough. We live in a zero interest rate society now, but I still think upfront capital costs are going to be a big thing. And so I would tend to guess that big projects with good cost structures that have low upfront capital are going to be at the forefront of M&A. So if I had to pick three, those would be the ones.
When we're talking about capital expenditure and specifically late stage development projects that will within a year potentially be in production, assuming they raise the necessary CAPEX, there's been at least three companies that I'll mention here. Alexco Resources has said that they're moving forward with silver production at Keno Hill, and they're going to do a private placement. Mako Mining announced recently they're building a mine in Nicaragua, and they're going to do a private placement to cancel some debt, polish off the treasury, use it for CAPEX. And then a company I work with and am invested in, Arcana, has done a number of raises since last September, and they need to do that as part of the debt facility that they're trying to finalize before they go into production. What do you want to see on these junior miners that have, let's say, less than $40 million worth of CAPEX to raise? Would you like it to be primarily a debt facility? Because then once they go into production, they pay it off. It seems like they don't take away a little bit of the leverage. Do you view private placements as too dilutive if they're that close to producing in cash flow? What are your thoughts here?
That's a good question, but it's hard to answer because I think the question's always going to depend. If the company has a great share structure and they're at that point where they need that final 40 million for their hurdle, I probably wouldn't see a big issue with them, issuing more shares to raise that capital. On the other hand, if it's a company that's taken a while, maybe 6, 7, 8 years to get to where they are, they've got 500,000 shares out, and they need to maybe double that to get that last 40 or 50 million. Then you may have question marks over whether it should be an equity financing. Debt, if things don't go well, debt can be a tough thing to service. And, I think we're going to see that, at the country level, unfortunately, in our economies where, debt has spiraled out of control. And not only is the debt spiraled out of control, but servicing that debt on a yearly basis. And I think the same thing can happen with a junior company. The fact is they don't have cash flow, and thus, debt is a big risk. Whereas if you raise it through equity, you're diluting shareholders that have been loyal to you, but it doesn't have necessarily the same risk component. So I know I'm not fully answering your question, but I'd say it depends. It depends on the company and the situation. And I can see both scenarios working well for the company. And again, it just depends.
When I'm on board the ship, so to speak, then I don't want to see excessive dilution. So that's, from being on the ship, that's the vantage point that I look at these things from. And one company that you've mentioned on my show previously is O3 Mining. And you're on board with that company as an investment. And they just closed a $40 million bought deal on June 19th. What are your thoughts here when they have raised this much money? Was this a bother to you, or do you think you trust them with this raise?
Well, there's a couple different ways I can answer that. I think the first thing that I would say is that there are so many companies out there that I've seen and owned over the last probably decade that have had trouble raising money. And it's always, we're going to do 1,000-meter drill program, 2,000-meter, they don't hit, or, they have trouble raising money after the fact. And there's a lot of risk in that. And then you go to the other side into the Cisco group, and they sort of unique, and the first company that I've ever encountered that is seemingly able to raise money at the drop of a dime. Like, they raised $400 million to develop their Windfall project in a down market, which I find very impressive. The other side to that is, you're absolutely right. Dilution is the silent killer that too many investors don't pay much attention to, and they should. With this particular deal, this financing, what I think is really interesting, and it's sort of unique. It's basically to most of the Quebec junior miners. They're able to access charitable flow-through. And for those who don't know what that is, charitable flow-through has a large tax write-off. And so I think when I was looking at some of the statistics last year and talking to the different companies, typically a charitable flow-through placement is done at basically 80% premium on the current share price. So meaning if the company is trading for $1, that financing would be on average at $1.80. And so what's interesting about that, if you think about it, that's almost double the current share price, which means in actual fact, they're diluting by half as much. So that $40 million placement really, in actual fact, to most other junior companies is really like a 20. And Quebec in particular is interesting because they pay back roughly 30% for your basically your drilling expenditures. So that's an added bonus. And then one more note on the O3. So that wasn't all charitable flow through. I forget what the ratio between hard dollars and charitable flow through were, but there was a hard dollar component. But putting it all together, I'm very happy. O3 continues to be the largest position in my portfolio. The value proposition is exceptional, and they're aggressively going to drill their properties. And I have a lot of confidence that that value is going to be unlocked, even though you're right, that is a large amount of money to raise, and there is some dilution.
So you like the projects, you've spoken about that in the past, and obviously you have to trust the management to take this $40 million and create more value for you.
Absolutely. And that's actually, first and foremost, I think with any investment or speculation in the junior resource sector. This is why you continually will hear, the sages of the investment world, Rick Rule, they'll start their conversation with the people. And so you want to find those histories of successful people. But even on the other side of things, and this is why conferences to me were so valuable, is that you get a chance to meet the people and see how they interact with other people, see how they interact with you, how they answer your questions, how much time they give you. Once you start understanding who these people are and the value systems which they use to conduct themselves, I think you can realistically have a good idea of how they're going to conduct their business, when nobody's looking. And for me, Jose Vizquera is one of those guys that I trust and is going to be putting that money into the ground and, trying to unlock value. And the other side about Jose is that I believe he put in almost another $3 million into this placement, putting him and his family close to 10 million, I think. So he's putting his money where his mouth is too, which really helps.
We'll be right back after this word from our sponsor. Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. With these companies, exploration and development companies that are pre-revenue at this stage of the bull market, as gold is doing really well, almost $1,800. One company I work with and I own shares in is Osino Resources. Osino raised $14 million about 6 months ago. Then they just recently announced a bought deal that's going to be possibly as much as $17 million with the over-allotment. That comes with a warrant. So, and they already have a lot of in-the-money warrants. They already have a lot of money in the bank, 2 to 3 years. They have a lot of in-the-money warrant money that's going to be coming in. Then they went ahead and raised again. I mean, they're just cashed up. Is that what you want to see at this stage of the game? Do you think that's a smart move? If the executive is looking at this and saying, listen, gold's at almost a near all-time high again. If there's a pullback, I want to strike while the iron's hot, while these people are trying to offer me money.
Yeah, it's a great question, and it's something to contemplate. Again, I think it's one of these questions where it depends, where that company is in its development, what the market looks like, especially I think right now with the amount of uncertainty that's out there. And even though the gold thesis or the precious metal thesis, in my view, has never been better than it is today, and it just seems to get better every day because of the things that are going on in the economy. But I think that uncertainty, what it does to people is it does, force them to think, what, a year down the line, 2 years down the line. And the other side to that is I've been told by many, many successful CEOs in the business, when the money's there, take it. And so it comes down to one of those things where I think it depends on the company. I think the uncertainty that we're seeing right now leads to companies being more apt at taking as much money as they can right now to ensure that they're insulated. And again, as an investor, something you want to watch, and you want to ask the CEO or the someone on the team, like, well, so why are you raising all this money? Where is it all going to go? What is your 3 to 5 year plan? If you've got more than this year covered, how does this all trickle out? And once you get an understanding of that, I think you can make a decision on how you feel about what they did and whether you think it's smart or not. And then you make a decision from there, whether it's something you want to step away from, or if it's something you say, you know what, they just put us in a really good position to execute to where the ultimate goal is. And so bottom line, it's going to be on a company by company basis.
Yeah. And I think personally, it's really attractive when the CEO can say, hey, I have 4 to 5 years of cash right now. And it also puts them in a better negotiating position. We opened the discussion talking about M&A targets. If the company is an M&A target and they're getting interest from JV partners or majors or mid-tiers that want to buy the company, one of the most powerful positions you can have at the negotiation table is, I don't need you. I have 3 years of cash, right?
You're absolutely right, Bill. It is. Cash is, and that's the thing. Like, good people can't do anything without cash. And you're absolutely right. There's a number of different ways you can look at it, and that bargaining chip at the table is a big deal, and especially if you don't want to be taken over. So the ability to wait out a hostile takeover or whatever, you're absolutely right. Having the money, bottom line is a big deal.
Something I've been presented with more in this last year is board members or key shareholders or executives introducing a company to me, whether it's pre-IPO or whether it's like a dormant company that nobody's paying attention to. And I'll just term one of these categories as leaderless projects that I've been introduced to, where I'm told the project is so good. And I say, who's running it? Oh, well, we're looking for the CEO right now. I can't give you that information. Obviously that's not attractive to me, because I want to know who's going to be the captain, right? Even if this project is so great, like who's steering the ship. But what are some of your thoughts here, Brian?
Yeah, I think you want to be really careful. And, depending on, it's a really tough thing. And ultimately it comes down to who you trust. And, depending on what your position you're in and sort of what your anchoring is in terms of how you make decisions, I think some people should completely avoid it. And other people, I think that there can be calculated gamble, so to speak, if you can work through what a deal should look like or what a deal should look like to you, and kind of those things to look out for. Like in an RTO, when a private company is taking over a public shell, you want to know who controls the shell. How much of it? Is there a bunch of shares that could come on the market once this RTO happens? In an IPO, where are all the founder shares? Where are the seed shares? What price and how much and who got them? Starting to understand that architecture of the company, and then the people that feed into it, I think are keys. But in the basis of it, I'm like you. I prefer to know who exactly is going to be the captain of the ship, and I want to talk to them before I give my hard-earned money to them to just anybody. And but by the same token, though, if you are able to develop relationships with different people and you trust their opinion, I think that there's, by the same token, you do have an ability, particularly you, with how you view the sector and your knowledge, you can make those decisions, but you got to trust yourself.
Can you give us an inkling of what type of deal flow you're seeing? And, is this some of the best deal flow you've ever seen, or are you cautious with what's being presented to you?
Always cautious, maybe to the point of fault in some ways, but I'd rather say no than take that chance most of the time. So for me, the deal flow is incredible. I don't think I've actually seen this before, in my experience anyways. And I think there's some really good deals out there, and I haven't been afraid to participate. And I think, this next cycle that we're just starting is going to be really interesting with all the things that are going on in the world. The thesis for precious metals, in particular gold, just has never been better. And with some of the new companies that are coming out, and they're very good teams in my view, there could be a lot of value created and profits for investors. And so I think this is, out of all the sectors to be in right now, I think the gold sector is where you want to be.
You and I met about 2 years ago in person at the Sprott conference for the first time, and then we touched base at all the shared conferences that we attend: Beaver Creek, PDAC, Mines and Money. So I'm interested to get your thoughts on how this virtual conference and lack of in-person meetings might affect the sector moving forward. Have you thought through this? Like, what does this mean for investors and companies?
To me personally, I have mixed emotions about it. I personally like to meet the people. Like I mentioned earlier in our conversation, I think there's a component that you don't get in this virtual world. The other side to this, I've been asking CEOs, that have been participating in these virtual conferences and seeing how it's going. And there's a segment of the guys that say this is the best thing ever. Like some of them live in South America and they say, look, I hate having to travel to London or Vancouver to do, 2 days of meetings and then fly back. It's a lot. And I agree, it is a lot. But I still go back to the personal side of things. And I think that there's things that are gained from the investor side that being in person and that kind of networking, you're never going to get through the virtual stuff. And so to me personally, once we get past all this COVID stuff, I think, conferences are going to come back. And I do think they play such a crucial role in the investors world particularly. And for me, I look forward to it. And I think, again, any investor that hasn't been going to conferences, the free ones or the ones that cost, to me, that they've always been an invaluable part of the due diligence process. And I very much want to see them come back.
I'll never forget what you told me in a previous podcast we recorded, where you said you love to, or a key thing for you is to observe the executives during happy hour and to see what they're really like during that time.
Yeah, well, it's amazing what can happen when somebody gets a few drinks. A lot of those inhibitions come down, and in many cases you see who the real person is. And so, yeah, that's information and stuff that you can observe that doesn't cost you anything, but can be very telling into, who you're investing in.
Absolutely. Brian's website again is juniorstockreview.com. Go join his free email list and check out his subscription service. Brian, as always, appreciate your insights. Thanks for coming on today's show.
Thanks for having me, Bill.